So here we are with China, and obviously, as we talked about in segment 1, and then again in segment 4, the issues that continue and how China is so integral to the world, not telling anyone what they don't know. But when you look at China versus commodities and the growth and how they've diverged, and the problem is when you look at Chinese total imports just going through a floor, but commodity prices remaining elevated, there's kind of this disconnect. And even though, and the reason why is because storage is still at 1997 lows on the LME. We don't have this storage on a lot of these base metals, and which is protecting prices. Then you're getting that other deviation where the dollar index has only gotten stronger, and so have commodity prices. But again, as we talked about, the dollar has a lot of unique things as foreign reserves fall, and people need to go out and buy dollars to try to strengthen their reserves. As trade slows, if they're not getting dollars by trade, they have to go out and buy them, which again is creating some of these problems. But one of the things that we want to look at are what is happening with Chinese growth. And not surprising, and I've talked about it multiple times, but Chinese policymakers are talking about boosting infrastructure investment. Yay, we've seen it before. They haven't had a successful, which is a bond that can cover both interest and principal on an infrastructure loan in a very long time. So what is actually available? And when you start looking at what Xi is talking about, China's top policymakers boosting infrastructure investment, both long and short term. A Central Commission for Financial and Economic Affairs, chaired by President Xi. So when Xi kicked off the meeting by underscoring the importance of robust infrastructure for both economic development and national security. So what does he want? He also noted that modern infrastructure is critical to improving all citizens' lives in a nod to his ever-present common prosperity. Again, he's trying to push the common prosperity theme. Macro, industrial, and there's that little piece, ag. The group then laid out a laundry list of infrastructure investment priorities: regional airports, urban rail systems — they've been building rail forever — a comprehensive network for ports and waterways, large-scale projects for energy and water conservation, public health and emergency facilities, oil and gas pipelines, agriculture, and so on. But if you remember at the beginning of 2020, they cut the investment in rail because they said there's nothing left. And now all of a sudden they think that people forgot and they're back to investing in rail. But there was a ton of projects that were rail-based that were stopped, on high voltage that were stopped, like all of these things, because they just weren't good loans. But here we are trying to drum up the economy again. And again, it's all about trying to link what's happening here in common prosperity, trying to show, but again, this is all supply side. How are you helping demand? And we still don't have that being done in the right way. So the need for infrastructure build out at the juncture seems like more than a coincidence. If done right, building the infrastructure of the future now will both support short-term economic growth in an important political year and boost long-term competitiveness. But as we know, they've been investing in infrastructure for a very long time, with a multiplier that is well below 0, and again, that is below 1, which is just, again, more pressure that they're seeing. Now, the industrial profits were better, came in at 8.5% versus last month of 5%. But remember, that was March. Things have now gotten much worse as prices have gone up. And then a record decline in foreign holdings of bonds. And this is where you continue to see that essentially dumping, because there's the real estate sector is not just, that's isolated, it won't happen elsewhere. There is more and more fear now, especially as the numbers are just that much further away from the truth, where people are concerned about their Chinese exposure. But China will need stimulus. And these are just some metrics where just using some of the stuff from BCA research, they're saying that you're going to need at least a 20% increase and something comparable to 2020. And then adjusted total financing 12-month change, a large acceleration is required. The problem is law of diminishing returns. So if you put out the same as 2020, you won't get back what you did. So for every dollar is put out in 2020, let's just say it yielded 50 cents. But now for every dollar, you're going to yield 25 cents. So that means you're going to have to more than double your investment or your stimulus because, again, the law of diminishing returns, but they never tightened. They've only been easing since 2011 and then again aggressively after 2014 and then again in 2020. So where like, they don't have that, and as we keep talking about, if you think about a bow and arrow, if you don't tighten the bow, that arrow doesn't go anywhere. It goes a shorter distance, and then to a point where it goes nowhere. And that's the thing that we keep talking about, but that's what he wants. So Xi wants officials to do more to boost economic growth. Chinese President Xi Jinping has told officials to ensure that the country's economic growth outpaces the U.S.'s this year. According to people familiar. In meetings over the past few weeks, Xi told senior economic and financial officials that ensuring that the economy is stable and growing is important because it's critical to show that China's one-party system is superior alternative to Western liberal democracy and that the U.S. is declining both politically and economically. When Xi talks, officials listen. In response, Xi's calls to rev up growth. Chinese government agencies are discussing plans to accelerate big construction projects that have been canceled due to their fact that they are terrible projects or at least won't cover interest and principal, especially in the manufacturing, tech, energy, and food sectors, as well as to issue coupons to individuals to spur consumer spending. Now we're starting to finally see that move to demand side because people need some sort of spending, but that's going to increase the cost to the government, which is having trouble getting international debt. So how are you going to finance all of this? And this is where we start to come full circle. By making economic growth a political task, Xi is saying that it must get done. It's still going to be tough for China to reach that 5.5%. Beijing is clearly opening the fiscal taps. Will it loosen monetary as well? And fiscal taps have been open. They've cut rebates, they've cut VAT, they've issued rebates, they've cut VAT tax, they've cut taxes in general. So they've continued to cut for the last 4 years. So again, what more can happen? Because all of these cuts started with the trade war with President Trump. So again, there hasn't been any tightening since that point, leading to more problems ahead. So then when we take that a step forward and we look at the real estate sector, so the real estate sector has credit impulses, as we've been talking about, flatlined, now just kind of go waffle back and forth between slightly negative and slightly positive. But then real estate floor spacing has flatlined as the government and the PBOC has tried to do more. The PBOC essentially held a big meeting to talk about it. When you look, they are telling banks that they should lend more to struggling developers, trying to help them roll debt because there is a huge debt cliff that is happening now and through the rest of the year. And with essentially the international markets closed, a lot of this is going to have to come and fall under their hands. So the relaxed lending requirements for developers acquiring projects at an early stage of development, extend overdue loans if developers provide additional credit, pledges, and continue to make real estate development loans to struggling firms, all of which are terrible ideas when you think about the fact that the banks are already levered to the gills, and now you're going to ask them to leverage up again to issue debt to essentially other areas of the economy like, infrastructure and all these things that keep coming up. So again, a lot of good money after bad without really cleaning up some of these problems. The PBOC requested that the financial institutions specifically help the dozen developers, a group that include Evergrande, Sunac, and Shimoa, and all of the companies that are effectively bankrupt, they want them to continue to lend to, which is an underlying problem. The PBOC has repeatedly leaned on banks to lend more. These efforts have failed to turn around the declining fortunes of the Chinese private sector developers, which is what we've been talking about. Just because you give them more money, you're finding out they have so much bad debt that there's no way to get this back above water. Any additional support for the property sector is welcome, but it's going to be a limitation of where it goes, which is why new construction has been falling sharply since 2021, and that we don't see that adjusting anytime soon. All the while, Chinese home price growth continues to come down in the primary and secondary market, which, as we've talked about, the real estate sector is a huge moneymaker for the provincial level, city level, town level, and then people, 60 to 65% of their wealth are in their homes, with prices continuing to weaken. And all of this leads to what we've seen so far and continues to get worse, with the sales manager index now firmly negative. China's central bank pledged to support the economy through targeted financing for small businesses and a quick resolution on the ongoing crackdown on tech firms. People's Bank of China will step up the prudent monetary policy support into the real economy. And here's why, because everything has gone negative. Business confidence through the floor and going negative. Market growth steeply negative and in contraction. And that's when you take that to the next level and look at sales growth all moving the wrong direction. Prices charged moving in a better direction. But again, where our input and factory prices, where factory prices are going up, so prices charged coming down is going to stress the underlying margin. And then when you look at staffing levels are down, which is why when you look at profit margins, if prices charged are down, factory gate prices are elevated, well, your margins are now negative and getting worse, all while they're trying to drum up more and have investment. This does not lead to investment. But the government still wants people to buy a lot of stuff. So under the influence of the pandemic, consumption, particularly brick and mortar consumption, has recovered slowly. Small and medium-sized businesses, sole proprietorships, and the service industry face many difficulties. What does Beijing want? Implementation of tax and fee reductions for small enterprises. Already done that. They're supposed to get checks next month, April, May, and June for those pieces. So that was already known. Reduced borrowing rates. Good luck. Even though the rates are coming down, they're not taking the additional money. Stable prices for key products such as grain, meat, cooking. So again, also becomes a problem because can't pass on costs. Construction of new suburban warehouses. Again, all of these things are leading to more slowdowns. Policymakers want and need consumption to play a bigger role, especially as we see the global market struggling. As we showed in segment 1, you're getting a bigger pivot into Mexico, into Vietnam, into other places outside of China, which will be a long-term headwind. Now turning to Japan, CPI came in at 1.2%. Year over year came in at, ex fresh food came in at 0.8, ex fresh food energy came in at negative 0.7, but CPI overall came in at 1.2%. PMI slightly positive. PMI services 50.5, composite 50.9, with manufacturing 53.4. Manufacturing, again, all of that kind of weakening just a bit. PPI up, not surprising, coming in at 1.3% versus the estimate of 1.2. Leading indicators, again, fairly flattish, with department store sales, fairly flat as well. The problem is inflation and where some of these pivots, because you still have some headwinds to inflation that are starting to abate and the comps will get different. And that's going to, again, send this higher when you start looking at, because the artificial low nature of their CPI is hiding just how bad some of the pricing moves are, and the U.S. imports a lot of that. So the composite output back to positive, but just barely, which is why we continue to see some of these pressure points. And this is what we've been talking about. So when you look at transport and communications, that is a big draw, essentially helps pull down where they are on the, and its adjustment to taxes and other. So when you look at food ramping up, when you look at fuel and utilities ramping up, so once you back out, because if you take away this transport and communication side, I mean, you're looking at inflation that's well over 3%. And that's, I think, something that is missed when you look at the pressure that remains in other areas, i.e. Japan. So then when you start looking at yen depreciation and where things are on soaring input prices, so more inflation to come, because as the yen devalues, it's going to cost more yen to import, which is they're going to have to try to pass through. Japan headline and core inflation divergence, headline inflation higher, core inflation down. And that's again because of that little piece on the communication side, which is going to, again, kind of fade into the background, and that prices will come elsewhere. But we do see more inflation ahead. Headline inflation versus target. India remains very elevated. Thailand, Philippines, Indonesia, the only one that is lower because they have a lot of price controls. The question is, will they be able to maintain them as the cost of doing that remains elevated? Headline inflation versus the 10-year, again, still remains a bigger problem as we go forward, which is why we look at inflation so specifically. Aggressive U.S. monetary tightening will hurt Asian exports for a lot of reasons because it makes them, it's harder to make, harder to get fund stuff. The lines of credit are more expensive. Everything becomes more expensive as the dollar strengthens, as the 10-year goes up, because the U.S. 10-year is a big factor for that. Now, Taiwan exports remain elevated. ASEAN exports remain elevated. We just think that is going to slow as we get that developed market continuing to slow down their purchases, as we talked about in segment 1. South Korea GDP right in line. We think that they were able to maintain that with exports remaining at gangbuster rates. Things have remained strong. Local consumption has been weak. But even though local consumption, the export market more than covered those pressure points, which is why we continue to see steady growth out of South Korea. But Korean debt and dwindling workforce is similar to what we saw in Japan. So the question is, when you look at the amount of private debt in Korea, which has exploded, Japanese private debt, as you can see, versus that, and then the Korean working age, this is where you start looking at some of the pressure that is going to be there over the longer term, especially as some of this additional manufacturing pivots to Vietnam, Mexico, Malaysia, Indonesia, India, some of the other areas. Not to say that it'll all leave, because there's a lot of value there, but all these problems remain. And that's why when you look at South Korea's productivity growth is set to continue its downward trend, leading to some headwinds for economic expansion. So that's what we have for you today on the Asian front. If you have any questions, you can find us on Twitter, on my email. Always happy to discuss. And thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.